Today we are going to talk about mutual funds and other pooled investment vehicles, primarily focusing on mutual funds. So broadly speaking, we can think about investment companies which pool together the funds, the capital from individual investors, and then offer management of those monies, right? So mutual fund is an example of an investment company, but there are other types of investment companies out there. So broadly speaking, these the biggest advantage of using this types of investment vehicles like mutual funds for your investment purposes is diversification. Mutual funds and other investment vehicles offer a low cost diversification. I mean, you can think about say S&P 500 index fund, right? That's a portfolio of 500 stocks, and creating such a portfolio on your own it can be quite cumbersome, but you can easily get that same exposure to 500 stocks in S&P index simply by investing in a S&P 500 index mutual fund, which can actually be invested into at a very low cost, right? So diversification at low cost, that is the biggest advantage of investing through these investment companies. They of course manage your records, send you like tax forms, dividend forms, things like that. So that part is also taken care of. You get the expertise of professional managers, and overall your transaction costs are lower because mutual funds can offer economies of scale, so they can actually create very large portfolios, and they can transact at lower cost because if you think about like fixed investment costs, they can be quite low if the portfolio is very large. So investment companies are financial intermediaries between the investors, the clients, and the companies in which the money is invested, right? So how do we compute the share value for a mutual fund or other investment companies? So if you think about mutual funds, one of the key differences between a mutual fund and say an individual stock is that even though mutual funds also have shares, they do not trade on the market like an individual stock, right? So the share price has to be computed. It's not determined in the market like the share price of an individual stock. And the way the share price of a mutual fund is calculated, it's calculated using the this idea of net asset value. So the share price is actually referred to as net asset value or NAV, assets minus liabilities per share. Okay, so let's say a mutual fund has total assets under management of 100 million, uh, liabilities. So these are the liabilities of the fund. Let's say those are 5 million. Sometimes they are there, sometimes funds don't have any liabilities, and the number of shares outstanding for that particular fund is say 10 million, right? So the net asset value or NAV is assets minus liabilities divided by the total number of shares, right? Assets minus liabilities divided by total number of shares. So 100 million minus 5 million over 10 million shares, that gives you the value per share, which is $9.50. So we'll say that the net asset value of this particular mutual fund is $9.50. And as the value of the assets change on a regular basis, right? I mean, if you think about S&P 500 index fund, the value of the assets for that fund would basically be the total value of the underlying 500 stocks that make up the portfolio. So as the value changes of those underlying stocks, the value of the total assets of the fund would change, and therefore the NAV is also going to change. However, as I mentioned before, the mutual funds do not trade on exchanges like individual stocks, so their NAV does not change continuously. In fact, the NAV is updated only once every day. After the close of the market at 4 p.m. Eastern Time, the net asset value of the fund is computed based on the total value of assets and liabilities, and by dividing the difference by the total number of shares. So let me actually show you an example here. I'm going to use the example of a Vanguard mutual fund. You can choose any other mutual fund, and you can find similar type of information. I'm just randomly choosing a Vanguard mutual fund here. Let me find an equity fund here. So let's say I choose this dividend growth fund. All right, this is a stock fund, uh, and here on the website for that particular fund, you can see the price as of 417, right? $27.70. So that is the net asset value of the Vanguard fund. So after the close of trading on April 17th, the NAV is updated. If you are an investor, for example, in this particular fund, 4 p.m. Eastern time is when the market closes for trading, and after a couple of hours, so say around 6 p.m. Eastern time or so, you will see the updated NAV. And the NAV calculation uses the closing prices, right? So whatever was the last available transaction price for the shares or the securities that make up the fund, that price is used in determining the net asset value. Okay, so the important thing to remember here is that NAV is computed only once every day, and it is updated after the close of trading in the market. So the NAV is updated only once every trading day. All right. So one other important thing that we are going to talk about later as well is that if you want to purchase the shares of a mutual fund, right, you can either purchase it directly from the investment company, or you can purchase it through your brokerage. Either way, the price that you see is not the price that you're going to get, right? So let's say you place your order on Monday when the market is open for trading. At that time, you will see the price that was calculated the previous day, right? So that would be on a Friday, right? So price was calculated on the previous trading day. So when you place your order during trading hours on Monday, you're not going to get the price that you observe, but you're going to get the price that will be calculated next. So that would be after the close of trading on Monday. So as long as you place your order before 4 p.m. Eastern time, your order would be fulfilled at that NAV that is calculated after the close of trading on that day. So 4 p.m. is Eastern time is the cutoff. If you place your order after 4 p.m. Eastern time, your order would be filled at next day's NAV, right? So next trading day's NAV. So basically, what this means is that anytime you place your order to purchase the shares in a mutual fund, you don't observe the actual price at which your order would be filled. The price that you are observing is actually a stale price. It's a previous price. The order is always filled at the next NAV. So if you place it before 4 p.m. Eastern time, then NAV is calculated after the close of market at 4 p.m. So your order would be filled at that NAV that is calculated that same day after the close of market. If you place your order after 4 p.m. Eastern time, then your NAV would be calculated at the following day's NAV after the market is closed and the NAV is computed. So you always get the next NAV when you place your order to purchase shares of mutual fund. All right, so that is important to remember in terms of how mutual funds work. Most investors are not familiar with this way of execution of mutual fund orders, because most people invest through their retirement accounts and things like that, and the money is automatically deducted from paychecks and deposited in their retirement accounts, and they don't really observe what's going on behind the scenes here. Okay, so that's the idea behind NAB. Again, like I said, most of our focus is going to be on mutual funds, but I do want to talk about some other types of investment companies as well. So one of those investment companies is unit investment trusts. Uh, Unit investment trusts are also pooled investment vehicles. Unit investment trusts are unmanaged. All right, unit investment trusts are unmanaged. So the way unit investment trusts work is that a portfolio of securities is set up at inception, and then that portfolio remains same for the life of the fund. There is no changes being made to the portfolio. So for example, let's say there is a unit investment trust that manages municipal bonds, right? So they select like 50 municipal bonds to invest in, and they will basically hold on to those 50 bonds. There would be no buying or selling of other securities for that portfolio. These would be the 50 securities, 50 bonds that would be held in the portfolio for the life of the fund, right? So these are unmanaged in the sense that there is no trading going on in unit investment trust. Other types of investment companies are managed. So open-end funds are what we commonly refer to as mutual funds, and then there are also these closed-end funds. Okay, so we'll talk about open-end and closed-end funds. So starting with closed-end funds, I already mentioned about open-end funds or mutual funds that they don't trade on the market, and their transaction takes place at net asset value. Net asset value is determined once every day, right? So that's for the mutual funds. Closed-end funds, however, actually are listed on the exchanges, and they do trade on the market like shares of individual stocks. So closed-end funds are different from mutual funds in the sense that they are actually listed on the exchanges. They follow all the same processes that we have for individual stocks. Closed-end funds do the IPO, then they get listed on the exchange, and they begin trading on the market. So they do have a market price, but they are portfolios of securities. They are actually funds. Okay, so they are portfolios of securities, but they trade on the market just like individual stocks. So they have a ticker symbol, and you can go to your brokerage, put in the ticker symbol, and you will see the bid and ask price. And so closed-end funds, they are bought and sold at the market price, just like shares of individual stocks. Open-end funds are mutual funds. They do not trade on the exchanges, so you have to buy and sell these funds either directly from the investment company, or you can also buy them from your brokerage accounts. But they are bought and sold at the net asset value, which is calculated once every day, right? So like I mentioned here, for open-end funds or mutual funds, the share price is actually the net asset value. For the closed-end funds, however, because these are portfolios of securities, they also have a net asset value, but they also have a market price because they are listed on the exchanges and they trade in the market like individual stocks. So closed-end funds have basically two prices. One is the net asset value, that is just the assets minus liabilities divided by number of shares, but they also have a market price. And a very puzzling thing about closed-end funds is that even though you would expect that the net asset value of the fund, which is essentially just the value of the underlying portfolio that or the value of the underlying securities that make up the portfolio, so you'd think that the net asset value of a closed-end fund should be similar to the share price, right? I mean, they should be pretty close to each other, these two numbers, the actual market price for the closed-end fund and the actual value of the portfolio, which is the NAV. But it turns out that there are oftentimes very big differences between the NAV and market price of a closed-end fund. These are just some examples to illustrate that. These are all closed-end fund uh, companies, closed-end mutual funds. So you can see their ticker symbol here in the parenthesis. You have the net asset value. Again, this is the total value of the portfolio net of any liabilities. and here you have the actual market price at the same time that you are observing the net asset value, right? So here you can see, for example, that for this particular fund ADX, the market price is about 13.8% below the net asset value, right? So there is a big difference between the market price and NAV. In most of the cases, you can see here, for most of the cases, these funds are actually trading at a discount. In the market, their price is lower than the net asset value. Most of the closed-end funds, they trade at a discount to their net asset value, which is actually a big puzzle. I mean, people have been trying to understand why is there sometimes such a big price difference between market price and NAV. And like I said, most often these closed-end funds, they trade at a discount to their net asset value, right? So the easy way to think about this is that if you were to say liquidate this fund, right, sell all the shares of the fund, satisfy all the obligations, pay out the liabilities, you would be able to recover $12.89 per share, right? That's obtained by selling all the securities in the portfolio and satisfying all the liabilities. So that is the actual value of the securities making of the portfolio, and yet the market price is actually much lower than what you can get from liquidating the value. So that seems like an arbitrage opportunity, but in reality it is not, because many times this difference can actually persist for a very long time, and it can actually even get worse over time. So this is not a simple straightforward case of simply buying when the market price is below the net asset value and hoping for the market price to catch up with the net asset value. It doesn't work that way in case of closed-end funds. So there are some explanations as to why there is this difference. We are not going to go into the details of that, but again, the important thing to remember is what is referred to as the closed-end fund discount puzzle, closed-end fund discount puzzle, that their market price is often trade is lower than the net asset value for this closed-end funds. Okay. So in case of let's see, yeah, for closed-end funds, you basically buy and sell at the market price. So the number of shares does not change, right? Because if you are buying, some other investor might be selling, just like shares of individual stocks. But for open-end funds, anytime there is a buying or selling going on, the number of shares are actually changing, right? New shares are being created or redeemed all the time in case of open-end funds or mutual funds, because they do not trade in the market. All right, so that's the distinction between open-end funds and closed-end funds.